Welcome to Seubert Spring Surety Update. Joining me today from Pittsburgh is Josh Restuari, and joining from our West Palm Beach office are Richard Zimmerman and Matt Eperesi. Today, we will provide a general market update, discuss a few underwriting-related items, and then discuss our outlook for 2024 and 2025. First up, Matt will talk about the NASBP, one of the ways surety professionals can stay in tune with what is happening in the surety marketplace.
Thanks, Will. So to start, Will, Josh, and I attended the 2024 NASBP meeting earlier this month in Austin, Texas. And for those of you who aren't as familiar with the NASBP, I'll go ahead and start by just talking a little bit about what the NASBP is. NASBP stands for National Association of Surety Bond Producers. It was an association founded back in 1942, and it's really put in place to advocate for the surety industry, and they do various different things to advocate for surety bonds from the federal, state, and local standpoint. I'll read you quickly the NASBP mission. It's to strengthen professionalism, expertise, and innovation in surety to advocate its use worldwide. So obviously, that's kind of their goal and their mission. And as professional surety bond agents, and Seubert as a professional surety bond agency, we take that very seriously, and that's something that we are extremely happy to be a part of and value. So as I mentioned, Will, Josh, and I attended the meeting in Austin, and we had a few notes just to kind of go over what was spoke about there and some of the highlights coming from that meeting. 2023 was a great year for the surety industry, and Will's going to touch on that more so after me. But looking beyond, 2024, we're looking for an optimistic year. Construction spending remains pretty high from a public standpoint. And in the private sector, depending on the marketplace that you're in, which we'll go into some specifics for the marketplace, different marketplaces that Seubert works in, the private side is also increasing, and then some areas it is decreasing. As far as the main points of this meeting, from an overall standpoint, reinsurance was a big topic that was spoke about, mainly because there has been some losses in the industry. We're coming off of many years of phenomenal loss ratios and really good loss numbers. So, and a slight uptick last year, despite still being a good year, there was a slight uptick, causes some change ups in the reinsurance market. So what we were hearing from most of the carriers and from most of the speakers there was renewals are getting a little bit tighter. They're getting a little bit tougher. There's some more due diligence on the reinsurer side. And because of that, terms and pricing have kind of gone up and made things a little bit more difficult. And that in turn, ultimately does change underwriting slightly. A big part of the surety industry, moving forward is the technology that goes along with the industry. It's been a very archaic industry for many years, still using wet signatures, seals, powers. The big challenge for the surety industry ahead is updating the technology. We've made phenomenal strides, and many of the sureties have adopted DocuSign for GIAs and various other things. But the biggest sticking point for most surety companies and agents is the obligees. The obligees across the country are just slow to adopt technology and slow to adopt more efficient ways of executing and submitting bonds. Many people across the industry are feeling the same pain. The NASBP, in collaborative with the institutes, is going through a process of updating and seeing what is out there on the cutting edge for ultimately executing bonds in a much more efficient process through blockchain. And so they have set up a RiskStream Collaborative, which is designed to say what's out there for bonds. How are we going to process this through the blockchain? Many people don't even understand what blockchain is. And so it's kind of educating the industry, but in conjunction with that, also educating the owners along with that. When it comes to underwriting, we're seeing a lot of different things in the construction marketplace, and a big topic for many of the underwriters and agents and construction owners is private equity. We've seen an uptick in private equity over the past several years, and private equity, as within any industry, is throwing out some big numbers for many contractors, but it's caused a big challenge for sureties who feel that sometimes these private equity firms are overvaluing construction firms and saddling the companies with debt. And so that remains to be top of mind for many sureties, especially on existing accounts where they've had long-term relationships, and this is a direction that the owner wants to go in, and it's a very beneficial avenue for the owner. But there's many things that need to be taken into account there. One being the surety bond program, and so sureties are remaining very selective in what they will ultimately write in that area. But they're still optimistic that they're trying to put things together. There's, like most things in surety, it's not a blanket statement across the board for what they can write within private equity. It's very much a case by case basis. And anytime you're thinking about or going down the road of an avenue of continuity or changing hands of the business, it is something that you should bring your surety agent in on and get your underwriter engaged and understand how that's going to ultimately affect the bond program, which could affect the business greatly. As I mentioned earlier, with reinsurance, part of the reason for the reinsurance really being tougher this year more than in the past is because of the increase in loss activity. As I mentioned, that the surety industry still had a good, decent year in 2023, but severity of claims were much more than prior years. So a lot of these claims were in the upper dollar levels that would blow through the underwriter, the surety's initial limits, and then go through to the reinsurer. So because of that, a lot of these reinsurance limits are increased, and the surety is taking on much more of that bear of the losses, and so that for that reason they get a little bit tighter. They're crossing T's and dotting I's a little bit more. Even on good accounts, they will underwrite more, and you may notice that some more information is asked for. Understand that that's just part of the process. That doesn't mean that the surety industry is changing or your underwriter is changing. It's just it's a part of the process and the ebbs and flows of the surety industry. There's a lot of concerns out there with labor issues, inflation, lingering supply chain issues still from COVID. Those are things that are going to be top of mind of your underwriter. And, at this point in time, with all the inflation that we've had, several years ago, a $2 million job is now a $4 million job. The increase in contract prices has gone up so rapidly and so drastically that many of our contractors and many of contractors across the country are having the largest backlogs that they've ever seen. And with that comes a lot more added risk from a surety standpoint. So your underwriter is going to be focused on that. That's kind of the summary that I've had of all of our meetings in Austin. And overall for 2024, we're looking optimistic. 2025 is still unknown. So I think that many of us are looking to see how this year goes optimistically, but then determine how 2025 will be based on government spending and private sector growth. So.
Sure. Thanks, Matt. Yeah, as Matt just discussed, the big talk in our industry is reinsurance, and I'll dig into a little more details. 2023 was another profitable and historically excellent year for the surety industry. In fact, it was the 18th straight profitable year for sureties. However, there are reasons for pause. The direct loss ratio of 22.2% is up from 14.5% in 2022, and it's the second highest level since 2006, second only to 2020. While 22.2% is still an excellent result, the trend is something that every surety is paying attention to. The second reason for pause is, as Matt talked about, the reinsurance market just had its fourth straight losing year in surety, and the trend is continuing to rise with the losses getting greater. So how is it that the industry can have another very profitable year, yet the surety reinsurance market continues to lose money? This happens in a low loss frequency, high loss severity environment. Even though the loss activity has stayed low from a frequency standpoint, the losses that have occurred have been severe. For example, if a surety has $100 million in premium with $25 million in losses, historically, those losses were likely spread out amongst 15, 20, or more different accounts. Last year, in a lot of cases, many of the losses came from only a handful of accounts, and in some cases, only one or two accounts. So what does this mean for the market? First, the price of reinsurance will increase significantly. Second, the surety's attachment points already have and will continue to increase. The attachment point is the surety's level of loss retention with the reinsurers. It is typically on a per account basis. If the trend of increased loss ratios continues in 2024 and 2025, it could certainly lead to a noticeable tightening in the surety underwriting. However, unlike insurance, sureties underwrite to a 0% loss ratio, meaning they don't expect to have any losses when they support a bond. Because of this, the underwriting of a specific account or risk should stay consistent regardless of where the surety's attachment point may be. However, if those losses continue and the overall loss ratio of the industry starts creeping up to 30, 40%, that's where you're going to start seeing some noticeable tightening in the industry for sure. So what should contractors do in the coming years? One, just like any business relationship, communication is key. A surety underwriter, more than anything, wants to be an educated partner. Provide more frequent updates, meet more often, utilize Zoom and Teams. The more information you can provide, the better. When I was an underwriter, I'd always say, I can deal with good, bad, and ugly information. I can't deal with surprises or no information. So just make sure you're communicating. Two, partner with a surety professional that can navigate the surety market trends, provide short and long-term underwriting and business guidance, and in many cases, educate you on how the surety views your business, and also make sure both parties are on the same page. Josh, one thing we often see confusion around or misinterpretation is the underwriter's definition of backlog capacity or aggregate program compared to the contractor's definition of backlog.
Yep. When you're set up with a surety program, it is generally governed by two numbers, your single and your aggregate limit. Single is fairly self-explanatory, but the aggregate is made up of a few factors, and the different people can mean different things. So generally, your cost to complete on all bonded jobs, your cost to complete on all unbonded jobs, and your estimated costs on all bidded jobs are what make up the three factors that make up your aggregate limit, which you might refer to as your backlog. Sometimes a surety might just look at your cost to complete on bonded jobs, but that's generally a case-by-case basis. So what makes up what a surety would view as your aggregate limit? So generally, if you take your working capital, a rule of thumb would be you can take that times 10. So if you have 5 million of working capital, you could have 50 million of surety credit. But these are just guidelines, and they can move up or down depending on other factors within your business. And every bond that you would like to get is underwritten on its own. So some factors that could change your aggregate limit would be a strong equity position, strong or high amounts of personal liquidity, and a long relationship with the surety. The longer you're with the surety, the more they'll be willing, the more they'll know you, and the more they'll be willing to flex one way or the other. So some of the ways that could decrease would just be if you do not have a proper CPA, depending on what your overall balance sheet makeup would be. So that is why, as Will mentioned, having a professional surety advisor would be our job is to advise you on how to get the most aggregate that you can and have your business be set up for the best that it can be.
And Josh, as you know, all the sureties have different appetites, and working capital isn't the end all be all for every surety. You know, some sureties look at equity. Some sureties will go to 30 or 40 times working capital in the right situation. You know, so it differs across the board, and every case, every account is written on its own merits, underwritten on its own merits, and looked at individually. But thanks, Josh. Lastly, we want to provide our thoughts for 2024 and beyond. Richard, what are some of the things you're seeing down in Florida?
Well, you know, we as you know, we write bonds all over the country, but I feel like Florida is a pocket of difference, a pocket of complexity that we don't see in other states that I've communicated with. So, in speaking with a number of the contractors that we work with down here, just talking about where the industry has gone. I mean, post-COVID, we were building condos and townhouses and apartments in craze because so many people were coming down. And now we're starting to kind of see a shift in that type of residential, but it's different in different pockets in Florida. So Florida really being such a large state, there's north of Orlando and south of Orlando are treated differently by contractors. So the north of Orlando seems to be more staying along the lines of condos and apartments. But south of Orlando, we've seen a shift to mixed use construction. And it's kind of created a different level of difficulty for some of the prime contractors and even subcontractors. So some of the challenge that we've seen down here were a shrinkage in the number of suppliers that are being able to provide to our contractors. They're merging together, creating less quantity of them, which is creating less competition, which is creating higher prices. And we all know that, you know, more competition gives you normally lower prices. The opposite's the case when they start shrinking. So in speaking to, you know, a few of our contractors, they feel like they're at the mercy of the supplier now. They're not able to have any favorable terms in their contract language. Sometimes, you know, in the past you had time to pay. In this case, a lot of times you have to prepay. So it's changing how a contractor's balance sheet looks short term as well, having to outlay that capital and not having the ability to make terms more efficient. And this also has made pricing go up and margins shrink, and makes a contractor have to take on more work just to keep the doors open and keep the lights on. Something that I think is unique to Florida recently that I've seen is the local banking has tightened up. We have relationships with a number of the local banks, and we're starting to see them have the same feelings that a lot of the sureties are, which is things are tightening up. They're looking at things with more scrutiny. So I've not heard this as much outside of Florida, so that's why I wanted to bring that to part. But the biggest problem that Will, that I've been hearing down here is the labor market. The labor market, the shortage that we have of skilled workers down here has exponentially grown, and I think it's because so much work has come here, and not so many workers have come here. And even worse, the trade schools down here that are pumping out new employees are not doing a very good job of keeping them in Florida. They're, you know, not paying them enough because of the cost of living down here is so significant. So you're seeing a lot of the skilled labor that comes out of the labor pool down here going to other parts of the country that they can, you know, live up and buy something more reasonably. So that's the, you know, I think some of the I'd love to see and more of in Florida is that they talk about those trade school shortages and try to improve that labor price. And the cost of labor, because of lack of labor, to get a project manager or supervisor, there's just so much more money being paid to do that, to keep someone down here, and there's no loyalty. So they're not going to, if someone else offers them more money, they're going to make the switch. And, that old school mentality of having loyalty in the system is gone. The handshake deals for materials are gone, and it's creating some frustration in a lot of our contractors. For the trend in terms of business, I think there's going to be more money and as much money as we can actually do work. And that's the key. Is there's tons of money in Florida to be spent, but there's not tons of contractors able to do the work necessary to spend that money. So hopefully we'll see as we head closer to the end of the fiscal year, September, that there'll be some better improvements on that. But it doesn't look like it's going to change until we have a significant change in skilled labor. I think a contractor in Florida, particularly south of Orlando, has to maybe think about reinventing themselves. The old, let's just make a bunch of residential and they'll come by it, seems to be shifting, and we're seeing the private work going more to commercial work. And that, of course, creates its own challenges, which is, what happens when the pool is bigger at chasing commercial work. Again, you have smaller margins, have to do more work, stretch yourself thinner, and that's where failure happens oftentimes. So my suggestion to contractors is that you talk to your agent partner for bonding, you be proactive and getting that done, because I do think that's particularly Southeast Florida is going to be much more stringent in the underwriting, and you can speak more of that, Will, but I think there's pockets like Texas and Florida and California that are going to look a little different than the rest of the country in the surety world. So being proactive and getting ahead of getting your bond line set up so that when that shift happens and you've already made that transition from private to commercial, you'll be prepared.
For sure. Richard, I think also in the past, when Florida's had a robust construction market, maybe the rest of the country hasn't been, just like Texas and California, there've been pockets in time in the past where, those markets have been robust, and, somewhere like Pittsburgh hasn't. And that's just not the case. And that's right now. And that's why I think you're seeing a lot more labor issues in some of these areas, because, there's really no shortage of work across the country right now. Within 100 miles of downtown Pittsburgh alone, there are over 45 projects that are in either design, pre-construction, or final planning phases, with budgets of at least $100 million, including several over $1 billion. And this isn't unique to Pittsburgh. There just isn't a shortage of work across the country, and especially, the public work. As contract prices continue to grow for single projects and backlogs continue to increase, the surety support through its understanding of contractors' financial and business plans will only increase in importance over the next several years, as will the value of professional surety agents, such as the three gentlemen that joined me here today. But that's it for our time today. We thank everyone for joining us for our insights and information. Richard, Matt, Josh, thank you for joining me today. We appreciate everyone's time. Please feel free to reach out to any one of us for additional information or insights. And we thank you. Have a great day, everyone.
Thank you.